This company, I've always thought of this company as your baby. You started it 35 years ago, you grew it into this phenomenal thing, and I was really surprised when I heard that you were going to go ahead and do an IPO, because I wondered what you're missing. Is it the quarterly calls with investors you're looking forward to? Why are you doing this?
Well, Jay gets to handle all that, so I can't speak to that, but I will say that we just thought it was the right move for our company at this time. You know, 35 years in, got thousands of people now working for the company, and they all are stockholders now, which is a great thing. Something we've always wanted to do. That's hard to do in a sub-S corporation, private company situation. But you can do it in a public. So we want to use our stock as currency and potentially acquire more fintech organizations and put them in the mold. So there's better access to the capital markets. And there's a lot of reasons. You probably know them all yourself, I'm sure. But we're excited about it. And if I could borrow a line from Jeff Bezos, we're in a get-rich-slow scheme here. 35 years in.
35 years.
Hey guys, welcome back to the Capital Mindset Show. We're your hosts, Austin and Fabio, here today. And today we have something special. It's kind of a quasi part two to our initial video on Rocket that we did earlier. And today we're kind of exploring really the recently announced share buyback program. So Fabio, can you kind of take this away into a brief introduction into what a share buyback is, some of its implications, why it's usually a good thing, and then also why here it might not be?
Yeah, so share buyback programs are typically a way for businesses to return capital to shareholders in the form of share repurchases. What does this mean? Very briefly, for those who might not know, it is when the total shares outstanding are reduced by the company by buying them back and ripping them up and basically making them disappear. And so what the remaining shareholders stand to benefit from this is they have an increased stake in the business. And if they want to remain long-term, they're basically getting to own more and more of the business. Additionally, in the US jurisdiction, share buybacks are a tax-efficient way of returning capital to shareholders. That's not in every jurisdiction, but at least in the United States, it is the most or one of the most efficient ways. Now, we're going to do a very brief review of Rocket Mortgage and its share structure. For those who missed that, we have a video. It was our previous one. So this is like a quasi part two video to Rocket Mortgage. And what we can see here is the share structure. And we're going to be focusing on the importance of the buyback and what that means. But again, if you want greater detail about the share structure, go watch that video.
Which will be linked in the pinned comment below, just to cut in here for one quick second.
No, go for it. Shout that out. So what we can see here is there are a couple ways in which the share buyback might be nullified or made ineffective. So we own what's called the Class A common stock, and you would hope that the buyback is going towards this. However, the buyback can go to both A or D common stock. And there's a problem here. So we like to align ourselves with the incentives of management, or not in this case management, those who control the business. In this case, Dan Gilbert or Rock Holdings. So if Dan Gilbert were to, for example, hypothetically, completely eliminate Class D common stock, right? What would occur is he would lose the entirety of his voting power. He would issue all those Class D into Class A, right? And he would lose all the voting power. Sure, he loses control of the company, but he remains with 92% economic interest, right? So basically, any money coming up, any money coming up the chain here. So any money coming up here will go mostly to Rock Holdings or Dan Gilbert, and then the remaining 8% goes up to you, right? So even if they lose the entirety of control, they remain with economic interest. This is to highlight that they are separate arrangements. Okay, going forward, if the buybacks are focused entirely on the D common stock, all that will happen is Class A gains voting power. They actually gain no new economic interest because each Class A common stock is fighting amongst that 8% economic interest. So the only way for the remaining shareholders to gain economic interest in and of themselves is for the reduction of Class A common stock. If Class D common stock is reduced, that nullifies the gain in economic interest. right? Because if you eliminate, let's say, one Class D common stock, they didn't get any economic interest to begin with, because the economic interest is gained on a separate arrangement. Okay. So remember that both can be bought in the share buyback program. Okay, now let's do another scenario. Let's say new shares of Class D common stock are issued. That wouldn't do anything to either of you, essentially. Rock Holdings and Dan Gilbert would simply gain more voting rights. Okay, now let's do the other one. What happens if more Class A is issued? If more Class A is issued to raise capital, Rock Holdings and Dan Gilbert may lose voting power. However, they do not lose economic interest, which at the end of the day is what really matters for an investment.
And also, Fabio, just to kind of cut in here for a quick second, would you kind of break down why they may lose or may not lose voting power, yet will not lose any economic interest here? Would you kind of break that down for maybe someone that isn't exactly keeping up to speed with this? And would that be potentially because of a difference in relationships, for example?
Yes, it actually would be. So to reiterate that, in case no one's caught on to that, it's because there's a different arrangement going on here. There's a separate arrangement for the economic interest, and then there's another arrangement under the Class D common stock for the voting power. So they could have zero Class D common stock and still have 92% economic interest. It doesn't matter. However, again, you are the Class A shareholders, and if there are more Class A shares being issued in the market, you are losing your piece of the pie. You're getting a smaller piece of the pie. And then same thing, I'll reiterate this in case no one caught on. If they convert Class D to Class A, because that's the only way they can sell their shares. When they sell their Class D shares, they convert to Class A. If they just convert and they sell in the open market, that is almost the same thing as rocket companies here creating new A shares. It's the same thing in treatment, because you are sharing this 8% among more people. You're losing a piece of the pie. So the stock buyback program sounds like it's a lot, right? Because we know that it's how much, Austin? How much is the share buyback program?
$1 billion.
$1 billion.
$1 billion. Yes.
So if you take a look at the model, everything's been erased because the focus of this video is not for price targets. That was more in the first video. What we can see here is a market cap of $2.3 billion. That's that's double the buyback. So the buyback is effectively half of the market cap. What's strange about that, Austin?
Market cap seems really, really low, Fabio. Seems very low, actually.
It's because this model is accounting for the
Class A.
Class A, exactly,
Yes.
which is what you own. And if you go here, if you're probably like thinking that's wrong, you go here in Seeking Alpha and you can see, oh, it's 33. That's the true market cap. That's the market cap including A and D, right? But you can't own D, so D is irrelevant. D is only relevant and so that it can dilute you. Go.
It's true. And then, so for any of you guys who might be wondering where you can kind of see repurchase activity, issuance activity, etc., you would be able to find this in the statement of stockholders' equity. Just as an aside before Fabio continues his,
So then we can kind of see real quick the evidence that we want to highlight to our audience about the ability for the business or the statement of the business that they will buy either Class A and Class D right here. And you can see here, they did buy back some shares. They bought back Class A shares. I know that for a fact. These are Class A shares they bought back. And this is the number of shares they bought back and the total amount repurchased. Now, however, there's a little bit of a caveat to this. We'll take a look somewhere else. I want to show this screen here. This is also from the same SEC documents. And we can see an issuance of Class A that is greater than the amount repurchased. This is a low amount. If you take the dollar amount, this is again like $8 million, and this is about $16 million, give or take. So it's nothing really. But remember that thing I showed everyone when I said that Class D can convert to Class A, and that is essentially the same thing as a dilution. It's almost the same thing. If effectively it is to Class A shareholders. Well, that's what's happening right here. So this is pretty crazy. An increase in controlling interest of investment net of income taxes, blah, 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 blah. Essentially, this is a creation of 20,200,000 shares. And right here, a deletion of 20,200,000 shares in Class D.
Disposition.
Yeah, disposition.
Yes.
That's the actual vocab term.
Yes.
Disposition, because they converted to Class A, right? What are they doing when they're converting to Class A? They are selling it. Okay, they're selling their D shares and getting cash for those A shares. These A shares are now being sold on the market. Okay, and so again, just to reiterate, this is effectively diluting you. They didn't create any new shares. All they did was convert other shares to existing shares. But remember, when you own A shares, you are essentially sharing the 8% pie with other A shareholders. All right. So going back, there's actually one more that I want to show them, and that's this, right? So here we see a public SEC trading report. And what we see here is the exact same number in a different way, just in case the other one didn't really quite make sense. I drew some arrows here to help us out. So the Class D is converted to Class A. So that's effectively a sell, right?
And then an immediate buy too, which is also the reason why there's a dollar symbol and then a dash next to that as well.
Yes, because there wasn't any actual, it wasn't exchanged at a price point at that moment.
Exactly.
And then it was sold under the Class A. So they sold Class D, bought Class A, and then sold at Class A. In English, they converted D to A and sold it. Okay,
and they sold A. Yes, yeah.
And they sold 20,200,000 shares. That is effectively a dilution. It's exactly the same thing in effect to you as a shareholder. You have to ask yourself, everything we've said here is not telling you whether or not the buybacks will be effective in creating shareholder value. That is another subject. We are just simply showing you the ways in which you can be diluted are a lot more than a traditional company. And you have to make the assumption that those buybacks will be used to your benefit and not to Class D shareholders' benefit. But the probability of that happening, I don't know. I can't put a probability to that. I can just tell you that there are more ways that I can think of that Class D will benefit than Class A. And there's one way that it will, Austin. And what is that one way that Class A shareholders will benefit?
Well, hold on. Let me ask one thing first, Fabio. So in essence, usually a share buyback plan will return capital to shareholders. Are you saying here that this is not necessarily the case?
This buyback, it is uncertain how it will be used to give capital to which shareholders, right? It is an uncertainty. I cannot sit here and tell you, Austin, that this $1 billion buyback will be geared towards Class A common stock. But however, I should note, okay, because not all doom and gloom, okay, they did do a special dividend that was exclusive to the A shareholders, right? They did that back when the big squeeze happened. Now, why they did this is entirely speculation as to why they decided to do this. And I don't want to get into that, but yeah, the buyback, you have to assume, if you think this is a buy, you have to assume, and if you're going to use the buyback as a bullish indicator, that it will be used in the most effective manner for Class A. And going back to the question, and you can pass the baton back if you and the audience as well are kind of like, well, I don't know which way is the best way. What do you think the best way the buyback could be towards Class A shareholders? I
would probably say in an ability that would grant Class A shareholders more voting rights. At least that's where my mind would go with this. Would that be correct in that assumption, Fabio?
Not necessarily, because the voting rights is simply the control of the business, but the value of any asset is the economic interest that you have, right? Voting rights are important, right? There's, like Google has Class A and Class C and Class B, and there's two options for you. There's Class A and Class C. Class B is owned by the founders. So Class C has no voting rights, but Class A has voting rights, but they have the equal economic interest, right? So you're just getting voting rights with Class A. In this case, the voting rights are the same, share per share, but the economic interests are separate. So this is the worst kind. I don't like this one. At least in the Google one, I have the same economic interest as Class A shareholders, because Class C was designed for employees. employees to get, and then Class A was separate. So the best scenario for a Class A shareholder would be if they did not issue any new shares, Class D shareholders do not convert, and the buyback is strictly used on Class A, because then, and only then, will the Class A shareholders increase in their economic interest. Not as a percentage basis on the total, that 8% will always remain 8%. But think of it like this. Instead of, like, if they did that, that would be $1 billion going to only $2 billion. So let's say there's 50 people in a room. Instead of 50 people sharing the 8%, only 25 will be sharing the 8%, assuming prices, stay the same. But you get what I'm saying with that. That's the best way. And that's what you're really hoping for if you think it's a really bullish catalyst, or somewhere in between. Okay. You just don't want it in those different scenarios that I outlined, that they do that, and that will strictly benefit Class D to the detriment of Class A. Okay. I want everyone to be aware that you could be entering what I call a piggy bank situation, where the Class A, the different classes are treated differently, and one class is a piggy bank for the other class shareholders, and one will simply not stand to benefit whatsoever. So you want to be very careful of that. That's why when we point these things out, we're not telling you that these are certainties as risks. We're highlighting them as potential risks. Those are all things that you have to consider when looking at this kind of company.
So to kind of add on to the scenario that I proposed earlier, where a buyback program that would result in more voting rights could be beneficial, Fabio actually wants to explore this now about why that might not be the case as well. So Fabio, why is it that, like, the scenario that I proposed, that most likely the audience may be thinking as well, might not be as beneficial as it could possibly sound?
Yeah, so in the scenario where the buyback is, for example, strictly focused on Class D shareholders, someone out there might be thinking, well, then I'm getting more voting rights, right? That's correct, because there's less shares of Class A and D, and so the A's will increase in voting control. Okay, but who really wins in this case? Well, Class D, right? They don't change in economic interest. They still keep that 92%. Okay. Class A gains voting rights, but remember that Class D still, if they go down only, like, for example, 20%, right? They still control the business because they originally had 80%. So they can realistically get down by 30% in the voting power, and they still control the business. Okay, so they keep control of the business. They keep control of the same exact economic interest. Nothing has changed. And they get a cash payout for those shares, right? So they win, win, and win. And then what happens to the A shareholders? Well, the A shareholders, they lose cash, right? The business that they own has lost cash. The cash was used to buy back shares. That's why sometimes share buybacks can be destroyers of shareholder value if used improperly. And remember that there's two classes of shares. So each share that's used to buy back the D shares, right, is cash that's otherwise not being returned to you, the Class A shareholder. So what I said earlier in the video is the Class A, the only way that it's truly purely beneficial to the Class A is if all of that cash is used for the Class A shareholders. Otherwise, it is misleading to really say it's a $1 billion buyback program. We really have to think about that, right? It's only a buyback program for the Class A's up to as the A shares are bought back and not diluted by the issuance of A shares through the conversion of the D shares. And if all of this is confusing you, you probably are, because it is confusing. Sometimes it's difficult to connect all these dots, and retail investors don't have, unless they're really putting in the time to understand it, they probably shouldn't be putting their hard-earned money into something like this. Something like this was cleverly designed by very professional accounting teams, right? And it allowed the founders to have many different avenues to legally, completely legal, do certain things that can benefit them to the detriment of those who bought the A shares. Now, I'm not saying they're going to do that. I'm not saying that. I'm simply saying that there are many ways they can do it, and therefore that is risk. Each way that they can do a certain thing that is a detriment to me is a risk, right? You have to consider that. So to reiterate, a buyback that goes all to the D, if you're thinking that that's good because you're getting more voting power, you must remember that you are not necessarily getting any new economic interest, and the business is expensing cash that is part of your business to buy out other shareholders that are not in the same boat as you, because they have separate economic interests already arranged under under a different arrangement with the previous company down below in that structure. So that's kind of the things I just wanted to add that I forgot to add. So you'll see this at the end of the video. And again, thank you guys for watching. If this was complicated, we can try to respond in the comments below to as many people as we can. Please reference our first video that focuses on the structure. This video is kind of to talk about the buyback program and some of the caveats that you really have to think about with the buyback program. Going forward, I would say that rocket companies is still something for me that just doesn't make sense. I don't know about you, Austin. What do you think?
I'm not buying it.
Which we forgot to in the original part of the video. So again, you'll see this at the end. So we're still not going to get involved in this business, but it was actually really fun for me and Austin to really go deep in the trenches with this business. If there's another business you guys want us to analyze, Austin, what do you think? We would want to do it, right?
Oh yeah, of course.
Definitely.
Of course. And especially too, take advantage of the fact that our channel is still small and we respond to all comments. And if you want us to kind of look into something and kind of look into its ownership structure or et cetera, we're willing to do that. We are more than willing to spend our time to really like devote ourselves to this, to what we're looking at, to this potential investment that we're looking at here.
It's fun for us guys.
Yes. Yeah, it is. It really is, to be honest. So with that being said, we really hope that you do like, comment, and subscribe. And also please share this video too, because if you found anything that you've seen here today helpful, by sharing the video, that really helps our channel grow. So we are your hosts, Austin and Fabio. We hope that you've enjoyed what you've seen here today, and we'll see you guys next time.